Hi everyone, it's Chris Varnas here with another Info Agent real estate video. Today we're going to deep dive into the ever hot topic of interest rates. This is a topic that can easily blow the cap off most people's heads, though it's something that all homeowners, purchasers, sellers, and yes, even tenants should be across. Understanding interest rates is crucial if you want to navigate the property market effectively, so we're going to explain this in easy to understand terms. By the end of this video, you'll have a solid understanding of how, when, and why interest rates rise and fall, what the RBA interest rate or RBA cash rate is and how it works and how it's related to interest rates, and what effects these can have on New South Wales and Sydney property prices and the rent market. So let's get into it. First, let's talk about the RBA, which stands for the Reserve Bank Australia. The RBA is Australia's central bank, responsible for maintaining stable prices, full employment, and economic prosperity. It does this by managing Australia's monetary policy, which includes setting the cash rate. So what is the cash rate? I'm sure you've come across the term cash rate before. Sometimes referred to as the RBA interest rate, the RBA cash rate is the interest rate charged to banks on overnight loans between them. Banks borrow from each other all the time, so this affects them quite heavily. It's a crucial tool the RBA uses to influence the broader economy. When the RBA adjusts the cash rate, it impacts short-term interest rates across the financial market. The relationship between the cash rate and other interest rates is complex. When the RBA adjusts the cash rate, it can affect other interest rates like mortgage rates and personal loan rates. But how? Remember when we said banks borrow from each other quite a lot? By increasing the cash rate, the RBA puts more financial pressure on the banks every time they borrow. This in turn forces those banks to have to charge us, the consumer, high interest rates to make up for their increased costs. In turn, what this means is that the RBA doesn't adjust the interest rates directly. It adjusts rates like the cash rate, which has a sort of ripple effect by forcing the hand of everyone else. So why would the RBA want to make the interest rate rise and fall? It seems like low interest rates would allow us all to achieve the Australian dream, right? Well, the RBA takes into account various factors like inflation, unemployment, and economic growth before making any changes to the cash rate. In periods where inflation is getting out of control, which is the rate at which prices for goods and services increase over time, real estate included, the RBA needs to control this. It might sound crazy, but one of the ways it does this is to increase household financial pressure so much that it stops us from spending money and forces those prices to drop. i.e., the interest rate on our loan for the house we just bought is now so high we can't afford to do anything else. On the flip side, the opposite is also true. In periods of economic downturn, the RBA may take steps to reduce interest rates, keeping the banks competitive and encouraging us to spend more money. Balance is extremely important. So how do changes in interest rates affect the property market in Sydney and New South Wales? Well, interest rate adjustments can impact property prices and demand. When interest rates are low, borrowing becomes cheaper, which can stimulate investment and increase demand for property. High demand increases competition, which means more bids and offers, equaling higher property prices. Conversely, higher interest rates can cool down the market. Purchasers' borrowing power can suddenly become much lower, reducing buyer demand for property. This can force property prices to be pulled back some as affordability is much lower. To clarify this, let's look at some case studies of past RBA cash rate changes and their effects on the Sydney and New South Wales property market. We'd say the most famous case was during the pandemic when the RBA reduced the cash rate to a record low of 0.1% in November of 2020. Thus, interest rates across Australia were reduced to an all-time low. This was done to stimulate spending and keep the economy going in a period that was likely to cause otherwise. During this time, we saw an unprecedented increase in property prices simply because the demand was so high with the supply remaining quite low. Conversely, as periods like these come to a close, if interest rates remain too low, money comes very cheap. This allows people to borrow money easily and buy all sorts of things like real estate, cars, boats, holidays, etc. Money can suddenly flow so quickly around the economy that inflation can experience a massive spike. It's here the RBA will have to step in and adjust the cash rate in the opposite direction to keep growth at a manageable level. It's important to note that the real estate market isn't the only market in the world, and it's certainly not the only market to feel these effects. We're sure you've all seen how the price of a cheeseburger and fries has changed over the last 10 years. If we allow inflation to remain unchecked, things that are usually deemed very cheap can suddenly not be. Not to mention things that were considered already expensive, like property, can very easily get well away from us. If you're a buyer, seller, or investor, it's crucial to understand how interest rate changes can affect your property decisions. Here are some tips to help you navigate fluctuating interest rates. For buyers, look for opportunities to lock in low interest rates and consider the long-term impact of interest rate changes on your mortgage repayments. For investors, keep an eye on interest rate trends and make investment decisions with both short-term and long-term interest rate dynamics in mind. For sellers, understand how interest rates can influence buyer demand and adjust your selling strategy accordingly. Yes, this may include the price, but don't worry. The property you're looking at purchasing next will most likely have suffered the same effect. This is our biggest reminder to sellers who are buying in the same market. Don't forget to take into account both transactions. Don't get lost in the stress of just one of them, or you might end up not making the move, when in some cases you may actually lose more by waiting for the market to increase again. Now let's take a closer look at how interest rates specifically impact rental price in Sydney and New South Wales. As we've discussed, interest rates can influence all sorts of things. This would include things like housing affordability, property investment, construction activity, consumer spending, and more. In this section, we'll examine how these factors come into play in the context of the New South Wales and Sydney rental market. Lower interest rates can make it more affordable for potential buyers to enter the market, which could result in reduced demand for rental properties in the area. This might lead to increased vacancy rates and downward pressure on rental prices. To complement this, lower interest rates could also make property investment more attractive, potentially increasing the supply of rental properties, further decreasing Sydney rental prices. On the flip side, higher interest rates could mean more would-be purchasers are pushed out of the property market and forced to rent. This can increase the demand in the Sydney rental market substantially, driving rental prices sky high. To give you one of our own case studies, our record for the busiest open home we've ever had for a rental property was during one such time. We had over 90 registered viewers and over 60 groups attend. We can tell you it was a solid fitness test running up and down those stairs and in and out of elevators. When it comes to construction activity, lower interest rates can stimulate development projects by making financing more affordable. In Sydney and other parts of New South Wales, this could lead to an increase in the supply of new rental properties. However, if demand doesn't keep up with the increased supply, rent prices may be negatively affected. Conversely, high interest rates can slow construction activity, slowing the appearance of new rental properties and keeping the supply the same. In case you haven't noticed, it's all about supply and demand. The final point on the effects interest rates have on rent prices is the increase in mortgage repayments experienced by landlords. We've mentioned how increasing the cash rate on banks forces them to increase the interest they charge their customers. They have to do this to stay afloat and keep up with their new expenses. If they didn't do this, well, then interest rates wouldn't rise and they would go under. Well, landlords and tenants experience this exact same relationship where the landlord is the bank and the tenant is the borrower. If the landlord's repayments increase, they are forced to charge the tenant more to stay afloat and keep up with their new expenses. This is just another ripple further down the line in controlling spending and is absolutely a part of the RBA's plan. If you're in a position where you need to know your property value or rental price, you can follow the links in the description down below or use our online property value calculator in the main menu of our website. Remember that it's the RBA that controls interest rates indirectly by adjusting things like the cash rate to create the ripple effect. It does this to control the economic balance across Australia. Make sure you adjust your property strategies accordingly to account for any potential fluctuations in interest rates. We hope this video helps you to make more informed decisions in your property journey. Don't forget to like and share this video if you found it helpful or know someone who will. You can subscribe to the channel or sign up for our newsletter on the homepage of our website below to never miss another video. We're creating a video encyclopedia on all things real estate, and doing so really helps us on our journey. Until next time, we'll see you then.